Hello trading friends and welcome back to Forex Focus, brought to you by tastyfx. Taking a close look at the Japanese yen here today in light of its best performance since 2008. We'll dig into why that 2008 year is so important. Obviously, the last time we saw a considerable bear stock market and the crash of 07, 08, in line with the financial crisis, having a lot to do with what we're seeing now versus seeing then. But yeah, this Japanese yen seeing considerable upside. Obviously, most of the news stories in the last few years have been bearish ones for the Japanese yen. We'll cover all of it, but first I do want to just cover what the heck's going on right now, as we've seen yen surge more than 8% in the last week of trading, the best week for yen since the 2008 financial crisis. And only in that time did it have 1 week like the week that we're seeing now. Now, there's a lot of context to add there, which we will a little later on, but crazy 5 trading sessions here, all of them lower for the US dollar. And this U.S. dollar lower by more than 1,000 pips in the last week here, as the big story has been the flight to quality, the risk on versus risk off, right? We're also seeing considerable downside in the same time in U.S. and Japanese equity markets. So this isn't a case of, Japan is stronger than the U.S. or anything like that. This has really been a safe haven or flight to quality bid that we've seen in the last couple of sessions, in the same time that we're seeing stock volatility and volatility really across every asset class rise. Now, how did we get here? What set this whole thing off? And, it's always hard. No stock market crash or major historical story or issue comes back to one number, but this was one that really pushed the market lower, and by that I mean the equity market, and then pushed fear markets or flight to quality markets higher, and is really being pointed to as maybe the straw that has broken the camel's back here in the recent bullish trend we've seen for equities, in line with that bearish trend for yen over the last several months. We had a U.S. employment number come out in the start of August that was reporting on July, that was unexpectedly higher in unemployment and also much lower for the jobs added in the month of July. Not only that, but this was the third month in a row that unemployment rates rose in the U.S. and now getting not only to that 4% number, which, as you can see, we haven't seen prior to the last few months here over the course of the last year, but now getting beyond it, and at this type of pace, potentially becoming a problem. The Fed likes inflation at 2% and unemployment rates around 4% here. And so if this continues, this could get out of hand really quickly. And the inflation that we've been talking about for the last couple of years quickly taking a backseat and becoming less important by the day, as it's no longer hyperinflation fear, it's recession fear that we're looking at, especially with numbers like this. So how does this affect the dollar yen? We'll get to more of the technical pieces in a second, but what we need is the context on interest rates. And also part of the reason for getting to a high unemployment rate, theoretically in an environment like this, is interest rates being too high for too long, too contractionary. And of course, if you have been following the inflation story of the last couple of years, it got as high as 8 or 9%. We've gotten it down to, depending on metrics that you're looking at, 2 to 3%. The Fed wanted it at 2% even, but in the splitting hairs, it seems they might have kept interest rates too high for a little too long. Because keep in mind that it's not like the Fed has had interest rates at 2% or 3% or 4% even to get that inflation down. It's been at a whopping 5.25% to 5.5%. And at certain points last year, it was projected to move even higher, as inflation wasn't moving higher last year, but it wasn't moving lower like they wanted. It was sticky, if you remember that story around the sticky inflation there. Now, so quickly have we turned on not caring so much about inflation, really worried about the employment data and what that means for a potential coming recession, that Fed funds futures are now pricing in a more than 35% chance that U.S. rates are under 4% by the end of the year. And keep in mind, I just told you they've been at 5.25% to 5.5% for the last year plus. And now the market thinking, with just 3 meetings from the Fed scheduled for the remainder of this year, that they'll cut that down to potentially 100 to 150 basis points lower than when they currently are. Now, if you've been following Fed action in recent years, they really only like to raise and cut interest rates by 25 basis points at a time. They'll raise or cut by 50 or 75 basis points. If you go back to the pandemic, they had not only emergency rate cuts, but they also cut by 50 and I think even 75 basis points at certain points in March of 2020. But does this warrant that emergency? So far, what we've been seeing is maybe some turbulence in that soft landing that everybody's been hoping for, and that Powell has been, in some ways witnessing over the last couple of months. And if it is just some turbulence on that soft landing, maybe not a case for an emergency rate cut, but in recent days, they've definitely solidified that the Fed needs to lower interest rates, and markets not really seeing any chance that the Fed either holds or hikes interest rates in coming months. So we'll see if they do use the emergency. But what is increasingly interesting is the dynamic by which traders of the Fed funds futures markets have priced in 100 to 150 basis points of cuts, and they only have 3 scheduled meetings for the remainder of the year. So that would mean if these odds play out anywhere like how they're currently distributed, we would likely see either a couple of 50 basis point cuts or maybe even a 75 to 100 basis point cut in September or one of the other remaining meetings. Let's bring this back to dollar yen, because not only is the Japanese yen a flight to quality in times like this, like the Swiss franc, you tend to see what I would maybe deem as risk-off currencies like that yen and franc catch a bid, whereas risk-on currencies like an Australian dollar or a South African rand or a Mexican peso, and even in this case, even on a relative basis, a US dollar, they can get hit in times like this, where volatility is rising, fear is rising, and there's a flight to quality or a safe haven or a risk-off market like the yen. But what's also going on in the background is the potential for that interest rate there at the top. That's the U.S. over the course of the last 5 years, having hiked to 5.5%, where we currently sit. And over that same period, especially if your eyes are looking from 2022 to present, the Bank of Japan interest rate on the lower part of your screen did not hike at any period throughout 2022 and 2023. Now, that chart has started to move up and to the right in 2024, but if you're looking at the y-axis there, Japanese interest rates still under 0.5 percentage point, while U.S. interest rates are still above 5%. But the way that futures traders are pricing interest rate markets in the U.S., what I just showed you, would coincide with U.S. interest rates coming down to maybe 4%, let's say around 4%, and Japanese interest rates now being at least positive, positive by 25 basis points or so. And so for carry traders in this forex market, you're talking about a interest rate differential going from 5.5%, maybe even more than that, because remember, Japan was negative interest rates for years, to now shrinking to 4% or maybe even lower of a differential if the Fed does cut by 100 to 150 basis points and the Bank of Japan stays here or even hikes further, as they've been trying to reel in some of the Japanese yen downside with a number of actions. But anyways, you're seeing this crazy move from a historical price extreme on one hand because of this flight to quality that we're seeing across all asset classes, but also it's in some ways an unwinding of one of the most wild historic carry trades of all time. And how can I help to support how wild and historic it was? Well, just a few weeks ago, this dollar yen market was above 160. That is the highest that we at tastyfx have data for, and we have data going all the way back to the early 1990s, and it was actually the highest price for a US dollar in Japanese yen going back to, I believe it was 1986 or 87. Either way, almost a 40-year extreme in price here for the US dollar. And so, like I say, and that interest rate differential getting out to more than 5% was a big part of that. And the carry trade was a big part of that. And also, it was just U.S. equities and the U.S. economy continuing to do well out of the pandemic when Japan and other Asian economies were not doing so well. Fast forward to now, we're seeing a dollar yen price in the mid 140s, which is still historically very high. We'll see if this is a blip on the radar of long-term U.S. dollar strength. But if you do look at the long-term for these forex prices, and forex is in a lot of ways an asset class that can be very mean reverting, it wasn't only just 3 or 4 years ago that this market was trading close to 100. And if you go back around 10 years, you've got double-digit prices for this dollar yen market. So it could be the start of a US dollar crash and long-term mean reversion, or it could be a blip as, again, to the point on the emergency Fed rate cut, it doesn't seem like at this current moment there's enough to warrant an all-out emergency or a recession is coming or this is, a bubble bursting. Right now it's more of maybe in a correction mode, but obviously you look at historical prices and there's plenty of room for this market to continue. And also, if you are able to look closely at the middle part of the chart, if you remember earlier, I told you that this is the best week for yen, worst week for this dollar yen here since 2008. If you look at the 2008 to 2010 range, that's when you're seeing a lot of 90 handle and 80 handle even for this dollar yen. So much different context. Wouldn't say necessarily we're in crash mode yet, but could very quickly get there given how high these prices are or have been relative to historical prices over the last 30 to 40 years. Last piece, I do want to correlate this action a little bit to what we're seeing in equity markets, and another flight to quality or fear measure or safe haven, whatever you want to call it, is this S&P 500 IV index, the VIX, which monitors option prices on the S&P 500 index. Essentially, if you don't trade options, you can think of options as insurance on a given market. And so if the VIX is moving higher, that tells you that S&P 500 options prices are moving higher, and thus insurance is moving higher. And why would insurance be moving higher? Well, there's demand for that insurance against a potential crash in the S&P. Now, is this indicative of what has to happen for the stock market? Absolutely not. The last time that we saw 60 plus prices in the VIX was that pandemic. Huge downside move in the S&P and other stock indices for sure, but it did bounce back and was printing all-time highs in months following that initial pandemic in February, March of 2020. That being said, you'll want to continue to monitor the yen price and this VIX market, and of course the Swiss franc, another safe haven or flight to quality, as they've all been pretty highly correlated in recent trade and likely to rise and fall with rising and falling fear in other asset classes. So we'll continue to watch it all. But yeah, best yen performance that we've seen in more than a decade. Stay tuned. Thanks.